Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi everybody, this is Yazad. Thank you so much for being here today. Last month, I had made a video about how prudent investors could consider dividend aristocrat stocks to create passive, predictable, and growing income to rely on whether the market moves up or down in these uncertain times. If you missed watching that video, you can watch it now by clicking here. I'm also adding a link in the description below. A dividend aristocrat is a company in the S&P BSE 500 index that not only consistently pays a dividend to its shareholders, but annually increases the size of its payout. Fundamentally strong, high dividend yielding stocks have historically presented growth opportunities even during bear markets and periods of uncertainty in equity markets. Continuing our series on the best dividend aristocrats to add to your watch list, this week we take a look at a stock that has declared 25 dividends in the last 15 years. And not just that, the average dividend yield of this stock for the last 7 years is a mind-boggling 8%. But does the stock qualify, as per our parameters, to be amongst the best of the best? In our previous video, we had identified 5 parameters for a stock to qualify for our list: a fundamentally sound company, good growth prospects and high return on equity, that's ROE, a stock that is fairly undervalued, a multi-year track record of paying phenomenal dividend payouts, and stocks that have consistently grown their dividends over the last 20 years. But to make our discussion even more comprehensive this time, we decided to dig in even deeper. We put our chosen dividend aristocrats through the rigorous test of our 5 parameters and then combined it with some aspects of the Canslim method wherever applicable. Canslim is a techno-fundamental strategy that helps one pick quality stocks focusing on companies that show acceleration in earnings. The word Canslim is an acronym for a 7-step process or a set of 7 rules that an investor is supposed to follow to pick quality stocks with very high growth potential. I had made a video about this method a while ago. You can watch it here to know all about Canslim. Now, does our stock make the cut? Intrigued to know the results? Watch to find out. Interest rates offered by banks on fixed deposits hardly beat inflation these days. A 365 days fixed deposit of HDFC Bank yields about 5.4%, whereas the current inflation rate hovers around 7%. Then there are stocks that have zoomed over 1,000% this year, but the companies have little, or in some cases nothing, to show in their financials. On the other hand, we have seen some cryptocurrencies zoom by over 5,000% last year, only to lose all the gains and much more within a matter of weeks in 2022. And then finally, we have a large cap stock that has robust financials and has been consistently paying dividends over the last 15 years. Not just any pittance of a dividend. The average dividend yield over the last 7 years has been a massive 8.12%. So what would you pick from the above choices in the current market situation? Well, I'm pretty sure that just like any wise investor, you too would choose to invest your hard-earned money in a large cap company that has a track record of paying enormous dividends consistently. If we are all in agreement, then without further ado, let us look at our dividend aristocrat of the month. Hindustan Zinc Limited is India's only and the world's leading producer of zinc, lead and silver. Over the last decade, the company has rewarded its investors with over 700 billion through dividends alone. Just take a moment to process this. Hindustan Zinc has paid its shareholders more money in just dividends since 2013 than the combined profits of Bajaj Finance, Asian Paints and Titan Company over the same period. Even then, the company has a strong liquid surplus of over 200 billion rupees as on date. Let us look at Hindustan Zinc's dividend history for the last 17 years. Starting with a modest dividend payout of just 5% of its face value in the financial year 2001-2002, the company has increased the dividends exponentially to as high as 1,470% per year. In 2017, HZL made history by making the largest aggregate dividend payout by any Indian company in a single financial year of rupees 271 billion. And just yesterday, the company has announced another massive dividend of 21 rupees per share, which is 1050% on a face value of rupees 2 for the financial year 2022-23, amounting to 88.7 billion rupees. At the current market price of 271, the dividend yield is a staggering 7.75%. The record date for the purpose of payment of interim dividend is 21st July 2022. And over the years, it's not just dividends that the company has rewarded its shareholders with. For a 10-year period starting from July 2012 till date, HZL has given a CAGR of 8.5% to its shareholders. For an investor looking for stable returns by investing in strong and large companies in the market, 8 to 10% is considered a reasonably good CAGR over the long term. Hence, now that we've established HZL's dominant dividend track record, we can tick off 2 out of our 5 parameters: a multi-year track record of paying phenomenal dividend payouts, and stocks that have consistently grown their dividends over the last 20 years. For the next part of our analysis, we have done something radically different for our viewers. We have tried to integrate the Canslim method using each letter of the acronym wherever possible along with our parameters. However, please note that Canslim is a method used to identify high growth stocks, whereas we are analyzing a high dividend yield stock. Hence, our goal here is to try and create a study using the best of both worlds. Let's take a look. The letter C in Canslim refers to current quarterly earnings. According to the method, investors should compare the earnings per share for the last 4 quarters of a company. A growth of 25% and above in EPS indicates that the company is both profitable and fast growing. EPS has grown from 4.6 in June 2021 to 6.9 in the quarter ended March 2022, a growth of 47%. A in Canslim refers to the annual earnings growth. The Canslim method emphasizes that a company's revenue and annual earnings should grow at least 25% for the last 3 years. And according to the method, the ROE must exceed 17%. This is a mixed bag. Although there has been a strong growth in revenue and profits in FY 2022, the growth in 2021 has been below the expected rate as per the Canslim method. Revenue and net profit declined in FY 2020 due to a halt in operations in late March 2020 on account of the COVID-19 lockdown and cyclically weak zinc and lead prices that were down by an average of 8% and 12% during the year. If we look at the return on equity, that's the ROE, the company checks the box with an ROE of 28, which is much higher than the 17% prescribed by the method. Hindustan Zinc is one of the world's largest and India's only integrated zinc, lead, silver producer. The company has mined metal capacity of around 1.2 million tons per annum, and it is aggressively expanding its mining capacities with 6 ongoing major mining projects. Hindustan Zinc, the world's second biggest zinc producer, operates the world's 3rd largest open pit mine and the world's largest zinc mine in Rampura, Rajasthan. In 2021, the company delivered its highest ever annual silver production of 706 tons. The company aspires to become the 3rd largest silver producer in the world by increasing its production to 1,000 tons a year from 700 tons. With a reserve base of 150 million metric tons and mineral resources of 297 million tons, HZL's mine life is over 25 years. This is in addition to bidding for new mining blocks in India to increase its local production. The company has confirmed that it will bid for new blocks of zinc and lead when the government of Rajasthan holds its auction later this year. Recently, the company has been looking at acquiring mining assets overseas in its bid to boost total annual production up to 2.5 million tons. This would help HZL hedge against having all its resources concentrated in India and also improve the logistics of carrying goods across the globe to cater to the US and Europe. HZL is also setting up a 30,000 ton per annum plant to manufacture zinc alloys shortly, which will not only help India cut its dependence on exports but also aid the company's bottom line. Zinc prices have rallied since 2020 over a long-standing mismatch between supply and demand, and despite global refined zinc output ramping up over recent months compared to 2020, it has still been outpaced by demand. Global base case mine production capability of zinc is forecast to peak at 14.9 metric tons in 2025 and gradually reduce, dwindling to just under 5 metric tons in 2050 from its 2025 peak. Demand for zinc is closely linked to the galvanized steel industry, which consumes around 70% of the zinc produced in India. A downturn in the economy could reduce demand for galvanized steel. Zinc also faces competition from substitutes such as aluminum and other alloys to produce galvanized steel. The N stands for a new product, service, or management. Being an old economy stock, there aren't many new product or service offerings for a company like HZL. However, as mentioned earlier, the company is looking at acquiring mining assets overseas and is also setting up a new plant to manufacture zinc alloys. S refers to supply and demand. As per Canslim, investors should look for stocks with fewer shares outstanding. These stocks can perform well as supply is restricted. HZL's promoter Vedanta Limited owns 64.9% stake in the company, while the Government of India holds a minority stake of 29.6%. Institutions and FIIs hold 3.8%. This leaves just 1.69% of the total shares available for day-to-day trading. Now, just as it is easier to tow a bike than a car, companies like HZL with a smaller number of shares available to trade are more likely to catapult higher than a company with a larger free float. According to Canslim, investors must look at buying the leading stock in a leading industry. The idea here is to distinguish the leaders from the laggards. With a market share of 78% by volume, HZL enjoys a leadership position in the domestic zinc market. High entry barriers such as capital-intensive operations and lack of zinc ore mines lend a competitive edge to the business risk profile. Presence in the global market also enhances revenue diversity. Does Hindustan Zinc have strong parentage, you may ask? Well, let's see. HZL is a subsidiary of Vedanta Limited, which owns 64.9% stake in it. Vedanta Limited, in turn, is a subsidiary of Vedanta Resources Limited, one of the world's leading oil and gas and metals company, with significant operations in oil and gas, zinc, lead, silver, copper, iron ore, steel and aluminum and power across India, South Africa and Namibia. Any other strong hands holding the stock? Well, there is the Government of India, if that impresses you. Well, that takes care of the I in Canslim. A company must have some institutional sponsorship. It doesn't get any better than having the backing of the Government of India. The Government of India holds a minority stake of 29.6% in the company. HZL was incorporated as a public sector firm in 1996 and the NDA government disinvested 26% in 2002 and a further 19% in 2003. Through this two-phase transaction, the government sold 45% of the company and ever since has retained 29.6%. One may argue that HZL has a very small free float with just two dominant stakeholders holding almost 95% of the stock, making it illiquid. But on the other hand, if such a company is well run, it can be a great place to invest, simply because the dominant investors have their interests aligned with yours over the long term. This means that in good and bad times, a large amount of the stock is locked up and is not available to be bought or sold. Strong hands hold the stock which is ideally a great place to be. It is pertinent, however, to mention that in May 2022, the Union Cabinet has approved the sale of the government's residual 29.6% stake in the company as part of the government's disinvestment drive in the current fiscal. Vedanta could bid for a 5% stake when the government sells its residual stake in HZL, the company's chairman Anil Agarwal had said recently. We have already covered the company's impressive dividend track record and growth in revenues and profits. Now let's take a quick look at some key figures and ratios for the financial year 21-22. EBITDA margin increased from 52% in 2021 to 59% in FY 2022, primarily due to an increase in revenue from operations on account of higher LME prices and increased zinc production. Net profit margin at 32% is much higher than the average net profit margin of the world's top 40 mining companies that stood at 17% in the same period. Finance costs are down from 386 crore rupees in the previous year to 296 crores in FY 2022. Current ratio has improved to 3.9 from 3.1 in FY 2021. This is on account of lower borrowings during the year. HZL has a healthy quick ratio of 3.6, which indicates that the company can comfortably meet its short-term obligations with its most liquid assets. Finally, the debt-to-equity ratio at a mere 0.08 shows the overall strong health of the company. Although there are many debt-free companies in India, HZL has achieved a rare feat by staying debt-free over a long period, even though it is engaged in the capital-intensive metals and mining industry. With this, we can tick another one of our boxes. The company is fundamentally sound and has robust financials. The final criteria of the method considers the general market direction. M. Most companies tend to follow the current direction or trend of the market. It is increasingly difficult for anyone to predict the market direction these days, with the sharp volatility that we have witnessed this year. Technically, we are not in a bear market yet, at least not by definition, which is a decline of 20% from its peak levels. The Nifty has come close with a decline of 17% earlier in June, but has bounced back since then and is currently trading close to 16,000 levels. It serves no purpose for an investor to predict the markets. Instead, one must find tried and tested methods to determine what is the best suited investment option in the present time. The very purpose of us looking at dividend aristocrats is that even during bear markets, when stock prices in general are falling, dividend investors seem to do better than growth stock investors. With companies like these, investors are rewarded regardless of movements in stock prices. Is the stock price of Hindustan Zinc undervalued? Let's take a look at some numbers. The return on equity at 28% is considered very good as per industry standards. The price to book ratio at 3.35 times is also fairly low. Some value investors consider any value under 3 as a good price to book ratio. Of course, deep value investors would hope to buy a stock at book value or lower. However, the standard for a good price to book value varies across industries. The enterprise value at 1,27,929 crores is more than the market cap of 1,14,865 crores as per today's closing price. As the name implies, enterprise value is the total value of a company, which includes both the market capitalization and the cost to pay off all the debt minus its cash. In this case, the enterprise value exceeding the market cap indicates that the stock may be undervalued. If we look at the PE ratio for the last 7 years, it has averaged at 13.1. The current PE of 11.9 is comparatively lower. Finally, let us look at the price to dividend ratio, which is often overlooked as investors usually look at the PE and other metrics. The price to dividend ratio accounts for cash flows and is a more trustworthy ratio as cash is actually being paid out, which means that the company is actually making money. HZL has a low price to dividend ratio of 12.9 times at the current market price. Effectively, this ratio also indicates how many years it will take for dividends to yield the original share price. If an investor invests for dividends, this is a useful metric. Dividend investing can be a great investment strategy as dividend stocks provide two sources of return: regular income from dividend payments and capital appreciation of the stock price. This total return can add up to create substantial wealth over time. Regular dividend increases lift the yield on an investor's original cost price. And just like we saw with HZL, if you stick around over the long term, a tiny 0.35% yield in 2002 could gradually increase to the current yield of 7.75% over time. One of the best things about dividend aristocrats is that these companies have long histories of annual dividend growth, which offers peace of mind to investors in uncertain times like the present. When a company manages to raise its dividend year after year, through bear markets, wars, recessions, and crises, it proves its financial resilience and its commitment to shareholders. Prudent investors should consider adding such high dividend stocks to their watch list as they are less risky in the current environment. That's all we have for this week. I hope you liked this video and thank you so much for watching. Remember, these videos are not recommendations or suggestions to buy any stocks and should not be treated as such. Rather, this is just honest research and credible ideas to educate and empower independent investors like you. This is Yazad signing off. Thanks again. Stay safe and goodbye.